Welcome back. In the last section, you set up the costing system and locked in your standard costs and the predetermined overhead rate. Now the factory floor comes alive. This is Phase C, where raw materials, labor, and overhead flow together into work in process and finally emerge as finished goods. Over the next few minutes, we will walk every stage of cost accumulation, from raising the production order to calculating the cost of goods manufactured. Grab a coffee, because this is where the numbers really start moving. Here is where we are headed. By the end of this section, you will be able to explain how a production order kicks off cost planning and apply the concepts of material mix, yield, and scrap as raw materials hit the floor. You will identify how equivalent units solve the problem of half-finished work and how labor and overhead get allocated, including the difference between over-applied and under-applied overhead. You will record the treatment of joint products, byproducts, spoilage, and rework. And finally, you will define the cost of goods manufactured statement and the crucial distinction between absorption and variable costing. That is a lot, so let us get moving. Every production run starts with a production order, sometimes called a work order or job order, raised from the approved bill of materials, the BOM. Why does this matter? Because the order is the contract for the run. It specifies the product, the quantity, the planned start and completion dates, the BOM version, the standard material and labor requirements, and the expected overhead. Here is the key thing about how costs get tracked. In job costing, each order gets its own job cost sheet that accumulates actual direct materials, direct labor, and applied overhead. In process costing, costs are accumulated by department for the whole period and divided by equivalent units. Same standards as a benchmark, different tracking. Once the order is approved, materials start to move. Materials leave the warehouse against a material requisition note, the MRN, which references the production order and the BOM. At that moment, the cost moves from raw materials inventory into work in process. Now watch three things closely. Mix matters when a product needs a blend, say an alloy of 60% steel and 40% aluminum. If the actual proportions drift, you get a mix variance. Yield is the output you get from your input. If 100 kilograms should give 90 but only gives 85, the yield variance captures that loss. And scrap, material with some recoverable value, splits in two. Normal scrap is already baked into the standard cost, but abnormal scrap is a period expense. Excess requisitions above standard need supervisor approval. Every one of these flags a variance to investigate later. How you accumulate work in process depends on the system you chose back in Stage 6. In job order costing, the job cost sheet is updated as costs land. Materials trace from the MRN, labor from time cards, and overhead is applied using the predetermined overhead rate times the actual base. When a job finishes, its total transfers to finished goods, and at any moment your WIP balance equals the sum of all open job sheets. In process costing, costs billed by department, and the challenge is those partially complete units in ending WIP, they must be expressed as equivalent units first. Two methods handle this. FIFO treats beginning WIP as a separate batch and measures only current period work, giving a purer efficiency read. Weighted average blends old and new costs and is simpler. That equivalent unit idea deserves its own slide. Here is the problem equivalent units solve. How do you fairly divide total process costs between units that are finished and units still half done in work in process? The answer is to convert physical units into equivalent whole units. An equivalent unit equals physical units times the percentage of completion for that cost element. And here is the surprising part. Materials, labor, and overhead can have different completion percentages on the same batch. If all materials go in at the start, they are 100% complete even when the units are only 60% processed for labor. Under the FIFO method, you count only current period work by subtracting the equivalent units already done and beginning WIP under weighted average. You treat everything as current period work. Cost per equivalent unit then values both transfers and ending WIP next, labor and overhead. Direct labor is the time worked directly on production, captured by time cards or the production system. Be careful here. Supervision, maintenance, quality inspection, and factory administration are not direct labor. They are overhead. Manufacturing overhead (MOH) gets allocated in two steps. First, overhead lands in cost pools or activity pools if you use activity-based costing. Second, it is applied to WIP using the predetermined overhead rate or activity rates. The applied overhead is debited to WIP, while actual overhead as incurred goes to the manufacturing overhead control account. At period end, the gap between applied and actual is the overhead variance. Remember this. When actual is less than applied, overhead is overapplied and favorable. When actual exceeds applied, it is underapplied and unfavorable. Sometimes one process yields several products at once. Sometimes a single process produces several distinct outputs. Think of refining crude oil into gasoline, diesel, and jet fuel, all valuable. The costs incurred before the split-off point are joint costs, and they must be allocated. The most common approach is the relative sales value method, which allocates joint cost in proportion to each product's sales value at split-off. When products cannot be sold at split-off, the net realizable value method allocates based on final price minus further processing costs. The physical output method splits by weight or volume. Simple, but it can mislead when prices differ widely. A constant gross margin method gives every product the same margin percentage. Byproducts with only minor value are handled either by reducing joint cost by their net realizable value or by recognizing their revenue when sold with no allocation. Now, not everything that comes off the line is good. This distinction is critical because it decides whether a loss sits in inventory or hits the income statement. Normal spoilage happens even under efficient conditions. It is expected, so its cost is spread across the good units, raising their per unit cost, and the standard cost card reflects that expected loss rate. Abnormal spoilage is the excess caused by a machine fault, operator error, or bad materials. It is never capitalized. It is expensed as a period loss because penalizing good units for an avoidable failure would distort their cost. Where you inspect also matters. Units spoiled before the inspection point get no cost, while units spoiled at or after it carry full processing cost and enter the equivalent unit count. Scrap with recovery value reduces overhead when normal and is a loss when abnormal. Rework follows the same normal versus abnormal logic. All of this rolls up into one final number. Completed production is inspected by quality control before it moves. Pass, and goods transfer at their accumulated cost. Fail, and the unit is reworked, downgraded, or scrapped. The headline number is the cost of goods manufactured, or COGM. The formula is clean. Beginning work in process plus total manufacturing cost for the period minus ending work in process equals COGM. Total manufacturing cost is raw materials used plus direct labor plus manufacturing overhead applied. Divide COGM by units completed and you get COGM per unit, which becomes the carrying value of your finished goods. In process costing, this is equivalent units times cost per equivalent unit. In job costing, it is the sum of all completed job sheets. Either way, WIP clears and finished goods is born. But how much cost actually sticks to inventory depends on one big choice. Here is the choice that changes your reported income. Under full absorption costing, both fixed and variable manufacturing costs are capitalized into inventory. Fixed overhead flows to cost of goods sold only when the inventory sells, not when it is produced. This is the method required for external reporting under Accounting Standards Codification 330 and International Accounting Standard 2. Under variable costing, only variable manufacturing costs go into inventory. Fixed overhead is expensed in the period it is incurred. This is used internally for decisions, but it is not allowed for external statements. The income difference between the two equals the fixed overhead sitting in ending inventory. When production exceeds sales, absorption shows higher income because some fixed overhead is parked in inventory rather than expensed. Let us see exactly why that happens. Let us make the income effect concrete. When production exceeds sales, absorption income is higher than variable income because the fixed overhead attached to the unsold units is sitting in ending inventory, not yet expensed. When production falls below sales, absorption income is lower because you are now expensing fixed overhead from prior periods as old inventory sells off. Variable costing behaves differently. Its income changes only with sales volume, never with production volume. That is actually a feature, not a bug. It removes the temptation to overproduce just to bury fixed costs in inventory and flatter this period's profit. For contribution margin, break-even, and make-or-buy decisions, variable costing gives the cleaner signal, though you always reconcile back to absorption for reporting. Let us pull the key points together. Since process costing leans so heavily on these two methods, let us be precise about the difference. FIFO process costing treats beginning work in process as a separate batch. Its cost per equivalent unit uses only current period cost divided by the equivalent units of current period work. That gives you a pure measure of this period's efficiency, which is exactly what you want when you are hunting for variances. Weighted average, by contrast, combines beginning WIP costs with current period costs and divides by total equivalent units, including work done in prior periods. It is simpler to calculate and smooths cost fluctuations, but it blurs the line between this period and the last. Most clients choose based on whether they prize precision or simplicity. Now for the takeaways. Step back and see why the cost of goods manufactured statement is the spine of this whole phase. It connects every cost input, materials, labor, and overhead, to the finished goods asset and ultimately to cost of goods sold. It is the central document of manufacturing cost accounting, which is why advisors must be able to reconstruct it from source data for any client. In practice, this means tracing requisitions, time cards, and overhead applications back into one coherent schedule. Get this right and the next phase falls into place. Because once you have accumulated actual costs against the standards you set, the obvious question becomes, how did actual compare to standard? That comparison is variance analysis, and it is exactly where we go next. Let us bring it home. Production orders launch cost accumulation, either by job on a job cost sheet or by department through equivalent units. As materials flow, you watch mix, yield, and scrap, and you sort spoilage and rework into normal, which is absorbed, and abnormal, which is expensed. Equivalent units and the predetermined overhead rate let you allocate cost fairly across finished and unfinished work, and joint costs split at the split-off point. It all converges on the cost of goods manufactured statement, beginning WIP plus total manufacturing cost minus ending WIP, which transfers cost into finished goods. And never forget the big choice. Absorption costing is required externally and capitalizes fixed overhead, while variable costing is an internal decision tool. Thank you for completing this section on manufacturing operations and cost accumulation.